Welcome back to The Explainer. Today, we're going to look past the incredibly noisy headlines of the week ending June 19, 2026, to uncover the massive financial infrastructure that's being built right under our noses. Now, if you've been glued to the charts this week, you might honestly think the only story in town is the day-to-day price action. But actually, scratch that. The strongest narrative in crypto right now isn't some random price swing or the latest meme coin. It's the relentless, quiet construction of a totally new market operating system.
Think about it like an iceberg. On the surface, yeah, the market tape still looks a little fragile, prices are bouncing around, and attention platforms like Pump.fun are driving all the weekly drama. But underneath all that noise, the market OS is getting incredibly serious. We are witnessing a profound shift away from a speculative casino toward deep, regulated, institutional infrastructure. The rails for the next decade of finance are literally being laid down right now.
So how do we make sense of all this? We're going to map out the architecture of this new market OS layer by layer. We'll start with stablecoins at the money layer, then hit tokenization at the asset layer, regulated exchanges at the execution layer, AI agents at the application layer, and finally wrap up with trust and security.
All right, first up, stablecoins as financial infrastructure.
Remember when the whole stablecoin debate was basically just USDT versus USDC? Well, those days are completely over. Now traditional financial giants like State Street are jumping in. They're launching a money market fund aligned with the proposed Genius Act, which means it's specifically designed to hold institutional stablecoin reserves. They're treating this as a serious, heavy-duty cash management problem. And right alongside that, you have AllUnity launching SEKU. That's a regulated Swedish krona stablecoin, fully backed by SEK reserves, redeemable one-to-one at par value. It's built for actual payments and on-chain settlement across networks like Ethereum, Polygon, and Solana.
What KINGFINITY points out here is absolutely crucial. Stablecoins are essentially splitting into three distinct lanes. You've got your global dollar liquidity, your regulated local currency e-money tokens like SEK, and then bank-led tokenized deposit models. So the real debate for institutions isn't which coin is going to win anymore. It's about which reserve model, redemption process, and legal jurisdiction they're actually going to trust with their massive balance sheets.
Moving right along to our second layer, tokenization and legal rights.
For the longest time, the tokenization narrative was basically just taking a real-world asset and slapping a digital wrapper on it. Kind of basic, right? But look at what Moody's is doing now. They're expanding their token integration engine to Solana through Alpha Ledger. They are literally attaching machine-readable credit ratings directly to tokenized fixed-income assets. Their goal is to make sure that independent credit analysis travels wherever the investors transact. They're bringing real, institutional-grade disclosure straight into on-chain markets.
And to see just how fast this space is maturing, you have to look at the base barrel upgrade, and specifically the B20 standard. We are way beyond basic ERC20 tokens here. This standard actually bakes compliance logic right into the code. We're talking built-in transfer policies, freeze and seize capabilities, role controls, and supply caps. The big credibility test today is whether a token carries clear rights and issuer controls, and Base is giving issuers the exact toolkit they need to do that safely.
Next up, Layer 3, regulated exchanges and markets. The momentum of regulatory approvals right now is just undeniable, and it's fundamentally changing how trading works. First, we saw the CFTC approve CallSheX's Bitcoin perpetual product as a futures contract with specific conditions. Then, Kraken launches CFTC-regulated perpetual futures for eligible U.S. clients through Bitnomial. That is a massive deal. It brings a huge offshore derivative structure straight into a regulated domestic venue. Meanwhile, over in Europe, as of June 19th, ESMA updated its interim register for the MiCA framework. That's the EU's sweeping crypto regulation that standardizes transparency and market integrity. The takeaway here? Exchanges aren't just competing on trading speed anymore. They are fiercely competing on legal structure, product design, and pure consumer trust.
Okay, let's step into Layer 4, where things get a bit sci-fi, AI agents and identity.
We talk all the time about AI agents doing tasks for us, right? But here's the multi-million-dollar question. How do they actually pay for things? Well, Alchemy just introduced a huge piece of the puzzle called Agent Card. Built with Visa Intelligent Commerce, it's a payments and identity platform designed specifically for AI agents. It literally gives an autonomous agent its own Visa payment token, a crypto wallet, an email, and a phone number. So the serious question isn't whether AI agents can transact anymore. It's who authorized them in the first place and exactly how their identity is verified on actual payment rails. And to do that without total chaos, you need incredibly strict boundaries. Visa is implementing essential guardrails through embedded credentials. They're enforcing strict spend controls, merchant category restrictions, transaction limits, and even routing between different payment rails. Because secure AI-initiated transactions require rigorous auditability. If an AI suddenly goes rogue, you need to know exactly how to pull the plug and trace those funds.
Finally, let's zoom out to our fifth layer: Treasuries, security, and trust.
Take just a second to absorb this number: 846,842 Bitcoin. That is MicroStrategy's aggregate holding as of mid-June. But you know what's even more fascinating than the sheer size of that stack? It's that this holding sits alongside a $1.1 billion reserve intended specifically to support preferred dividends and debt interest. They aren't just hoarding coins anymore. They are literally engineering corporate finance entirely around digital assets.
Because of this, digital asset treasury companies are evolving. They aren't just a vault, they are hybrid credit and equity vehicles. And because they're stepping into that arena, the market is evaluating them using traditional financial metrics. Investors are closely scrutinizing par stability, dividend coverage, liquidity reserves, seniority in the capital structure, and forced selling risk. The big takeaway for you is that massive crypto treasuries are now playing strictly by Wall Street's rules.
But, and there's always a but, right? Even as we build out these bulletproof institutional rails, the user layer is still highly vulnerable. Microsoft recently detailed a really nasty threat called crypto bandits. It's a crypto clipper worm that spreads through removable media and actually steals seed phrases and wallet addresses directly from a user's clipboard. Yikes. It's a harsh reminder that no matter how incredible the Market OS gets, wallet hygiene and endpoint security are still a massive part of the trust equation. If a user's computer is compromised, the whole system fails them.
So, as we wrap up, I really want you to think about how all these pieces interlock. The money layer, the asset layer, the regulated exchanges, and these massive corporate treasuries are all solidifying. But as autonomous machines start navigating this new architecture, the stakes are going to go through the roof. As this Market OS continues to mature beneath the surface, I'll leave you to ponder this absolutely critical question about the future of finance. What minimum control should AI agents need before they can move real money? Thanks so much for joining me for this explainer. Keep learning, and I'll see you next time.